Hour of trade. Let's get right to the floor show. And Osaic chief market strategist Phil Blancato, whose firm has $900 billion in assets under management. You manage $10 billion of that. This bond story, why should it matter to stock investors? It
matters because ultimately it means interest rates push higher. And inevitably, the stock market doesn't like high rates. And when you start to get high rates, things panic. And whether it's small caps, you saw a big hit today, where you see across the spectrum, higher rates, higher borrowing costs, less earnings, trouble for stocks. And by the way, we're going in the period of time of the year, September, the worst month of the year, usually starts about now. This is not unusual to see this kind of reaction.
This is a buying opportunity.
It is. You think about where we are in markets. We have the greatest earnings of maybe our lifetime. Net margins on the S&P 500 are fabulous. They're really quite incredible. It's not just the AI story. It's the picks and shovels of AI that I think are still opportunistic. And in the end, this is not a recessionary moment. You have great employment. Granted, a weakness in a Walmart has other things besides the U.S. consumer. So good unemployment, solid wage data, lower inflation recently. I mean, oil's a bit of an end factor here. But if you put it all together, economically, we're fine. It's just that these moments are fairly common when you have this instability of interest rates.
Okay, and I'm keeping my eye here on not just the Dow, but definitely the NASDAQ, down 259 points. And the Russell, the small caps are taking an outsized hit of 1 1/3%. So to what do you attribute that?
Interest rates is a correlation. You're thrilled about what AI can do for the small cap company. Increase efficiency, less people, much more productive. But at the end, they're the biggest borrowers. Now, their margins have been wonderful in the last 12 months. The stocks are doubling the S&P 500, so you got lots of room for cushion. But you've always had volatility in small caps because they're interest rate sensitive companies. It costs more to borrow. The less they produce, they're going to take a big hit on a day like this.
Secretary Bessent of the Treasury came out, and he was speaking first in an interview and then to the gaggle outside on the White House lawn. But some of the things he said were nothing magic about $40 trillion debt number. He also said there's a very good chance we've seen peak deficit. I don't know where he's getting the confidence. I'm glad he has the confidence, but this government continues to spend and spend, as did the Biden administration.
And the Obama administration.
And then, do you believe him when he said rates have nothing to do with the buyback decision of yesterday?
Yes and no. I would say right now the Treasury continues to have the opportunity to make these changes on the fringes, which provide liquidity. So if that's his motivation, wonderful. I don't know that we're in a liquidity crunch here. I think that's a little unusual. But there is tremendous demand from the federal government, obviously the amount of money we need to support the defense, and then beyond that, interest rates. Oh, and by the way, the AI sector spending $1 trillion need to borrow a lot of money. So, okay, maybe I'll give them some credence. The reality is they're spooked by a 30-year at 5.3. And if the 10-year breaks 4.75, that's really a mess. So I think they're trying to support a little here. I don't think it makes a profound difference.
Are you buying some names here? I know that you have a couple of names, including Goldman Sachs, that you feel have real room to run. I mean, Goldman's down about 1.7% right now. Dow is a price-weighted index. So because Goldman's price is so high, it's hitting the Dow harder than, say, Walmart's 9% loss at the moment. But why do you like Goldman?
It's easy. A $4 trillion company that had tremendous investment banking revenues. They're trading cheaper than J.P. Morgan and Morgan Stanley. You're looking at maybe as much as 40% earnings growth. Oh, and by the way, the best margins ever at Goldman.
Wait, can I just say, what do you mean by $4 trillion? The market cap's $292 billion.
When you look at assets under management that they manage, it's $4 trillion. Okay. That's an incredible number. So you think about that size of money. It's a cash register. It just keeps paying and paying and paying, and they grow it on a regular basis. So that's the kind of business model you want in times of volatility. If you can get great margin growth, and I can buy it cheaper than its 5-year average and cheaper than its peers, how do you not buy a great company?
Yeah, I'm looking at the forward PE right now of 14. That's certainly below a lot of these high-flying AI stocks.
Right, and look at, you get a decent dividend. And by the way, you get a company that has never failed. So why wouldn't I find a great company? This whole idea that my whole portfolio should be AI is dangerous, because is the juice worth the squeeze? Will this become this incredible return on investment? Maybe, but it might take 3, 4, 5 years for some of this. Look at NVIDIA, hasn't made any money in a year. I see everyone wants to buy it. Time out. Why wouldn't I balance my account and pair my stocks? A quality name like a Goldman that I can pair with an NVIDIA, because they're going to act very differently. That's how you make money in markets.
Phil Blancato, thank you very much.